This is the Equity Management Academy Weekend Podcast for November 24th, 2021. Turkey, the canary in the coal mine. Summary. Chairman Powell has been renominated. The market seemed to see this as a bearish sentiment. It is similar to what happened in June when all Powell did was talk about tapering with the idea that inflation is going to be transitory. Turkey this morning reached 20% inflation. Their central bank appears to have lost control of the monetary system. Fundamentals. Chairman Powell has been renominated. And the market appears to see this as a bearish sentiment. It is similar to what happened in June when all Powell did was talk about tapering with the idea that inflation is going to be transitory. He continues to believe that inflation will abate in the next few months. We are entering a crucial time with the GDP supply, the money supply exploding to record levels, debt running at 130% of GDP, and inflation globally is appearing everywhere. We see monetary inflation due to the stimulus that governments have been providing. The stimulus reduces the purchasing power of each unit of currency, so the dollar is worth less and less. Turkey this morning reached 20% inflation. The lira fell 9% Tuesday to as low as 0.08% or 13.45 to the US dollar, pushing losses to more than 19% over the past week and 23% over the past month. Their central bank appears to have lost control of the monetary system. We are approaching a hyperinflation in Turkey. If you are dealing with this level of debt and continue to reduce the strength of the US dollar, it aggravates the problem in the sense that it makes the dollar decline faster on top of the price inflation spiral. We also have a bottleneck of supplies. The inflation is going to continue for a few months, longer than expected, particularly if consumers are willing to pay the higher prices. Equity Management Academy CEO Patrick MontesDeOca said, on top of that, we have wage price inflation as labor shortages lead to higher wages, even as the standard of living declines with the dollar worth less and prices rising. Gold and silver have been recently affected by the amount of short selling in the paper markets. They have artificially brought the price down in the physical market by selling short in the paper market. We expect a major reversion up from these levels, MontesDeOca said. Silver should reach $24.91 in the coming week. Bitcoin is also due to a major move up as the US dollar's value continues to erode. The government, in the face of such debt levels, cannot raise interest rates. They may talk about it, they may taper, they may taper, but they cannot raise interest rates without risking a wave of defaults. The market may dictate higher interest rates if there is a downgrading of U.S. bonds. The government may also cap the long end of the market, the 30-year bond, and allow the short end of the market to invert, such as the 10-year note. So short-term rates would move higher while the government keeps long-term rates where most of the debt is stable to avoid a tsunami of defaults. Precious metals. For months, precious metals have been trading contrary to the fundamentals. Gold made a low in March 16, 2020, and then ran up. Silver reverted from the March 2020 lows to new highs of almost $30. Markets were discouraged and were discounting this tremendous stimulus coming into the market and wanted to see what damage the pandemic had done. You know, silver moved down in choppy trading until the Reddit crowd came in and drove the price up to $30, $33, catching a lot of shorts by surprise. Silver made a higher high, and then went into another corrective pattern with a new low in September. Now we are in the third leg of the long-term bull market in silver. This is not a bear market in silver, MontesDeOca said. It is a correction within a larger bull market. The third leg should equal the first leg, so we should have a move to almost $30. Which would mean roughly $50 silver after the third leg. Gold. Gold is down to 1790 and has activated a buy signal from the buy one level of 1788 for the day. The target is 1819. We are trading below the weekly buy two level of 1821 by closing below 1821. Gold activated a bearish price momentum with a target of 1788, which was completed early on November 23rd. Now we have a buy trigger with a stop of 1788, or you can use a maximum dollar stop depending on your control or your comfort level. If you are more aggressive, you can use a stop at 1771 as a protective level. Gold is approaching levels indicating accumulation of supply. It is activating buy triggers around the buy one and two levels of 1788 and 1771, which are the best levels at which to add to your long-term positions. Silver is down 80 cents, following the same pattern as gold. It went neutral on a close below 2403, which happened last night on November 22nd. The average daily price is $24.91 for the week. Silver is below that price, but near it, so we don't trade around it. We don't trade around the average daily price. We wait to trade extremes of the market which have the highest probability of a profitable trade. By closing above 24.91, we have a bullish weekly price momentum. The sell one levels of 24.91 for the weekly, which is the target. The daily signals target was 24.73. If the price moves up above that level, it becomes support, and the next target is 25.25. If silver comes down, then the buy two level come into play at 23.91 and 23.62. The buy levels are where you want to enter the market and go long or exit your short positions. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, EMA2trade.com, or listen to any of our previous episodes.
Good morning, everybody. Welcome to Live Trading Talk with Patrick MontesDeOca. Welcome back after a long weekend holiday, and I hope you had a great family with your loved ones here. We had a bit of a rocky weekend here as we got some scare, you might say, sellers that came into Friday's markets as a result of this new variant Omicron, which seems to be of a higher infectious possibilities based on the mutations that it has, I believe, close to about 30 different mutations. So it seems to be something that we want to watch again. The markets reacted on Friday, I believe overreacted on Friday, and they are adjusting this morning. As you can see, we're getting some green on the screen. Let's just take a few minutes here and allow for the market to adjust in this first hour of trading after a long weekend holiday. The Bitcoin market is up about 5.5-6% this morning, 57,340, and we have jumped in a gap, as you can see here, right above the average daily price of 55,960, and actually has gotten up to complete the daily target of 58,320. This is a perfect example of mean reversion trading. The market came down to 53,600 on the 26th at 3:45 a.m. and activated a weekly buy trigger, as you can see here. And we traded around this price range for about 6 hours until about 10:30 a.m. and then you can see this reversion unfolding here right through the mean and got up to the extreme above the structure for today of 58,320. So it has completed the mean reversion pattern that we trade from the extreme below the mean to the extreme above the mean. Now, by closing below after initiating the target, it has reverted a short trigger, daily trigger, by trading below 58,320, and the target for the day is 55,960. Unless it reverts back up above 58,320. So that is your risk for the day. Bitcoin is short from these levels, but it is up substantially overnight. Here's an example for if you're carrying a long-term position, for example, in Bitcoin, where you can use these signals to short the market short-term. Depending upon your profile, you can use a different number of variables or derivatives, I would say, that you can do that, depending upon your expertise and profile. Otherwise, if you're holding on to this long-term, we're getting back a reversion, basically activating the 60,500 target. For the rest of the week. So on the left, you see the daily signals. The trade was completed, but the weekly is still intact, bullish trigger point with a target of 60,500. Now, if you're carrying multiple positions, the shorter term day trade signals you can use to activate your targets. And so the daily met the first target of 58,320, and the sell to level for the day is 62,215. What you're seeing here is the mathematical probability that when it gets up to this level in red, between the sell 1 and sell 2, or the resistance levels, as most technical analysts would call it, you begin to identify a high level, a high probability that we can experience supply as it comes into these levels. And as you can see here, the market basically experienced exactly that supply that activated a short trigger. The algorithm trades daily, weekly, and monthly. So if you short it from here, you can trail now your position with a stop all the way down to the target. If it completes the target, it's not a guarantee that it's going to go down there. The market will do what it's going to do. And here we seem to be getting some buyers coming in. And so the market will dictate. The law of supply and demand will take effect. And we're going to see either more buying at these levels. And if it goes through 58,320, the market is saying that there are more buyers interested in paying up for these prices. And when it trades above 58,320, that becomes the support for the next higher fractal in prices. The weekly target is 60,500. The sell to daily for today is 58,320 to 62,215. I wanted you to listen to the report that we just published in the Associated Press, which has fundamentals involved, which are to a certain degree inverted to sometimes what the markets do in terms of real trading. As you can see on Friday, for example, we saw a massive correction pretty much across the board. And the reality is that the markets will interpret the fundamentals ahead of time. Price always knows, pretty much, the level that it wants to establish based on the supply and demand. And sometimes it may not necessarily be in accordance with the fundamentals. You know, the gold market is a perfect example of an inverted market to the fundamentals. As we looked at the weekly report, we can see pretty much in gold since March of last year that we've had pretty much an inverted market. But if we take a look at the bigger picture here, from the low that we made on April of 2019, that was the beginning of the bull market. And it went from 1226 to 2089, almost doubling in price from 2019. But then we collapsed in March, and we established this $600+ range that essentially was made by August 3rd, 2020. All the contracts being relative to high was 2089. And we have been in this corrective pattern again, contrary to the fundamentals that we saw here, which is basically the pandemic, the damage, the amount of stimulus that came into the market. And obviously, we saw here the market establishing a bottom here on March 8th, 1673.74, which was a 61.8% retracement from that big move previous. And we've been now establishing in this uptrend channel, this major uptrend channel that we have, completing, testing this support trend line that seems to be supporting the market at around 1765, 1777, which if we do for some reason get a chance to test these levels again, these levels would be the best possible buy-in entry for the year 2022. The area below the green, which is the average price weekly, in blue is the extreme below the mean. And what we are teaching our traders, our subscribers here, is how to trade the market from the extreme below the mean to the extreme above the mean. This is a highly probable mathematical matrix that allows self-directed traders to have the control pretty much to trade the market intelligently using mathematics. This is a combination of different indicators. It's a combination of WD-GAN, Fibonacci sequences, wave sequences, in addition to the algorithm that essentially activates the trigger points from the extreme below to tell you exactly when to enter to the extreme above, prospectively where the price targets are going to be located, so that you don't have any guessing to do. It's a question of how you manage your position based on your profile. So far, we have a fairly quiet market here this morning. Kind of a mixed feeling, adjusting to the holiday weekend. But Bitcoin is showing some buyers stepped up here at these levels, as you can see, coming down into this blue level weekly here. This is where the buying or accumulation of supply ideally is expected to take place. Now, when we include Fibonacci fans, for example, you can see that the market is trading in between the first and the second fan. If we include Fibonacci retracements, the fans fit right into the 50% Fibonacci retracement all the way to 49,545. And at a maximum extension of the Fibonacci retracement, we're looking at a 61.8% of 44,294 at the extreme. So far, the market is trading around the 38.2% retracement, Fibonacci retracement, and has found and validated the average price, the support, the weekly support, and the weekly trigger points. So what this does for me is it allows me to use the technical side of the market, the mathematics of the market, using this probability model without getting emotional in terms of the fundamentals of the market. And this tells me here basically to be patient. The market is trading above the weekly level of support, above the daily average of 55,960. And that would be a level if you wanted to use a protective level on your position, depending upon your profile. So that's pretty clear in terms of the trade that is recommended by the VCPMI. Let's take a look at silver. Pretty much following the same pattern as the gold market, has entered into the blue zone, where potentially we're going to see some buying come into the market. We made a low of 22.93.94. The average daily price is 23.28, and the buy one level is 22.78. Right below it, we have the daily and the weekly harmonically aligned at 22.38 to 22.44. And we've come down to a Fibonacci 61.8% retracement of 22.95, which is where pretty much the market is reverting from. So you can see the different metrics that I use to trade, primarily in terms of identifying the momentum of the market, not necessarily the price, which is what the VCPMI does. The VCPMI stands for the Variable Changing Price Momentum Indicator. The price is basically a consequence of the momentum. And when the market reaches these levels, the target is completed and it looks for the momentum of the next signal, the next trade. We are continuing to hold our long-term core position in precious metals. we're looking to add to that position on any corrections. And we are also looking to cover any hedges on any corrections. Look for the market to find support here for the rest of the week. And I thank you once again for the opportunity to share this incredible information with you, my friends. In the meantime, have a great trading day. I'll talk to you next time.